Morning, everybody. And firstly, apologies for the slightly delayed starting of this call. As I think you can appreciate under the current circumstances, we're having slight sort of technological challenges, but hopefully that shouldn't now affect us for the rest of the call. So a special thank you, I think, really for all of you for making the effort to join us today, as I recognize a lot of you are probably dialing in from personally rather challenging circumstances. My name is Hannah Grant. I'm the head of the Secretariat at the Access to Insurance Initiative. To those of you not familiar with us, we are the implementation partner of the IAIS and work with insurance supervisors to create an enabling environment for financial inclusion. Before I sort of get on to the first part, I think I understand there's a few housekeeping items I'm just going to mention. So we're a little bit late starting, so if that's okay with people, we'll probably maybe end sort of 5 to 10 minutes just after the hour. So today's webinar is scheduled to last 1 hour, and we will reserve some time at the end for Q&A. There is, to ensure the highest quality of experience, participants will be muted, but if towards the end you'd like to actually ask your question verbally, you can raise your hand and you can be unmuted. Questions can be also submitted via the Q&A feature, which you should be able to see at the bottom of your screen, and you can sort of type in your questions there. The slides and a recording of this presentation will be circulated later. And if there are any questions that we don't have time to answer in today's call, we will endeavour to get back to you via email to answer your questions. And if you have any sort of technological issues and things during the call, please just use the chat function, and the Microinsurance Network, I'm told, is monitoring it. Thank you. So yeah, climate risk insurance and micro-meso-macro solutions. I think that's the topic for today's call. As I mentioned, the A2II works with insurance supervisors, and climate risk insurance is a topic of great interest actually to insurance supervisors who are keen to play their role in helping insurance support efforts to build greater resilience in their countries. On this note, actually over the course of last year, actually together with the Microinsurance Network, we organised 3 different dialogue events, bringing together policymakers, insurance supervisors, industry and other interested stakeholders to discuss the role that insurance can play in closing the climate risk protection gap. Of the sort of topics and issues that emerged from those events, one of the key themes actually was the need for more dialogue and better coordination between stakeholders, both within a country, but also and at the same level, but particularly working on sort of different levels on micro, macro, meso level schemes. I'm therefore delighted to have the opportunity to moderate the panel today, and also hear from our 2 expert speakers and learn from the experiences in Pakistan and the Philippines. I will just briefly sort of introduce my 2 speakers, and then I'm going to say a few more things just to sort of introduce and give a little bit more context to today's session. So my first speaker is Mr. Michael Rellosa. He is Executive Director of the Philippines Insurers and Reinsurers Association. Prior to this, Mr. Rellosa was President and Chief Operating Officer of Fortune General Insurance Corporation. He is also the chairman of the ASEAN Insurance, or he also, sorry, was the chairman of the ASEAN Insurance Council between 2015 and 2016, and still holds actually the chairmanship of the Education Committee. My second speaker will be Mr. Syed Nayyar Hussain, who's Director of Market Development Policy and at the Policy and Regulation Department in the Insurance Division of the Securities and Exchange Commission of Pakistan. He has 21 years of experience working in the insurance sector, both now obviously with the supervisor, but previously with the insurance industry, and he is an actuary by training. So if we could actually just move on to the first sort of slide. And I just want to give a little bit of context to what the speakers will be talking about, and also just introduce some of the terms that you'll be hearing sort of throughout the presentation. And if we can go on, I think, to the 3rd slide. And the next slide, perfect, this one. So I just wanted to sort of start by putting in context, I think, and showing you what we mean by the natural catastrophe protection gap. And in the latest Sigma publication, the Swiss Re Institute put the figures of the global natural catastrophe protection gap at a staggering 280 billion in the last 2 years alone. And the graph we have here on the slide compares insured losses with uninsured losses. And what you can see is basically the significant amount of uninsured losses. And this becomes all the more significant when you look at sub-Saharan Africa, where actually less than 1% of losses are actually insured. And in Latin America as well, only 3% of losses are insured. If we move on to the next slide. But insurance solutions, as we'll discuss a bit more through the case studies on this, this presentation, at different levels are available. And some of these insurance solutions are direct solutions, other are indirect solutions. And the level really depends on who has the insurable interest, actually not who is actually the one who is paying the premium. So there are solutions available at the macro level, and this is where the government is the key policy holder. And here the government can use the payouts from the insurance scheme to finance disaster relief of efforts after a catastrophe, an emergency and also social protection schemes. An example here would be the African risk capacity. There are also solutions at the MESO level, and these solutions are aimed at protecting the financial service providers and risk aggregators such as banks, MFIs, agribusinesses, and many of the organizations that provide key services to the low-income population. And then, as I think probably most of you on this call are probably most familiar with, there are solutions also at the micro level. And these are risk transfer solutions that protect directly the individuals and smallholder farmers, householders, and small and micro entrepreneurs. And there are some examples mentioned on the slide, but I won't go into that more now because we've got some good examples coming up from both Pakistan and the Philippines. So if we just go on to the last slide, and I just wanted to sort of bring people's attention to a publication that the A2I put out at the end of last year, looking at the role that insurance supervisors can play in climate risk insurance. And I'd encourage you to go onto our website and sort of download this publication, which just examines different ways that insurance supervisors can play a role in helping to bridge the climate risk protection gap. Anyway, with no further ado, I'd like to hand over to my first speaker, Mr. Rellosa, to share his experiences from Philippines.
Good afternoon, ladies and gentlemen. Thanks for giving me this opportunity to share the current developments in the Philippines relative to climate risk insurance. Can we have the slides, please? Can we go on to the next slide? Okay, for starters, I would like to introduce Pilla, or the Philippine Insurers and Reinsurers Association, to give you an appreciation of where we are coming from and the perspective that we have in this initiative. Pilla is the umbrella organization of all general or non-life insurers in the Philippines. We do have a counterpart for the life sector, and that would be the Philippine Life Insurers Association, or Pilla. We currently have 57 members, including the state-owned GSIS, or Government Service Insurance System. Pilla serves as the industry's policy-making body. It advocates for the industry and its members. It provides technical support, serves as a liaison to and represents the industry to international groups, regulators, government agencies, so on and so forth. It also serves as a resource to the Philippine Congress or Senate or other bodies that may invite us, and finally serves as the voice of the industry. Slide 3, please. Now, what is the current state of CRI in the Philippines? Let me start by saying that we do have a catastrophic peril cover in the Philippines. Though it is not strictly speaking climate risk insurance, it does include specific climate-related risks such as typhoon and flood. Our cat perils cover include earthquake, typhoon, and flood. Earthquake, typhoon, and flood cover is usually an add-on to the typical fire policy and cannot be bought separately. Oh, it can be bought separately at an additional rate of about 0.15%. On the commercial side, this is purchased mostly by big business and to a lesser extent SMEs. This is also available for residential risks, but is purchased by homeowners mostly because it is a requirement by a bank or a financial institution relative to a loan. We can safely say that there is a sizable portion of the populace with little or no access to this type of coverage. Slide 4, please. Now, there are other CRI or disaster risk finance initiatives in various stages of development in the Philippines. First, we have the Insurance for Coastal Ecosystems. This is an initiative of the UK-based Earth Security Group and is initially funded by the German government. The objective of this program is to find possible risk transfer mechanisms and/or funding to help protect coastal ecosystems comprised of mangrove forests, seagrass meadows, and coral reefs against climate-related risks. Further meetings are scheduled third quarter of 2020 to see how this project can be brought to fruition. The second is the Catastrophe Reinsurance Facility or pool. This is a project of Pilla and one of our members, National Reinsurance Corporation of the Philippines, the only commercial reinsurance company in the Philippines. Now, this is done in support of the World Bank objectives. The program aims to maximize local cat retentions, pool the risks, obtain a common reinsurance cover for residuals, and in the process create a bigger capacity to write cat insurance while at the same time helping correct premium rates, which in the Philippines are at an all-time low. A technical working group called from major writers has been formed to talk about the product attributes and the mechanics of the facility. Meanwhile, the regulators or the Insurance Commission are in full support and has agreed to chair the steering committee of this initiative. The third initiative that we have in the Philippines is on agriculture insurance. This is an ADB-led and sponsored initiative, the objective of which is to get the private sector involved, lending its efficiencies and facility to covering the underserved portion of the agriculture sector against climate-related perils such as excess rainfall, drought, typhoon, and flood. Currently, it is only the state-owned Philippine Crop Insurance Corporation who is authorized by law to write agri-insurance in the Philippines, which in a large part is subsidized by the government. Over the years, the PCIC, or the Crop Insurance Corporation, has not been able to significantly improve its penetration rate. Currently, several product proposals are on the table for discussion, as well as the mechanics of how the PCIC and interested members of the private sector can work together. Then we have the fourth, climate risk insurance, and this is the GIZ-led program, where the GIZ was able to put together various sectors of the government and industry stakeholders to take stock of the information available and map out what needs to be done next, and also to come up with a product and a scheme for particular or identified local government units that will serve as a pilot, and the pilot of which could be later on scaled up if found viable. And the last is the V20 initiative. Now, this is a program led by the local secretariat of the V20, or it's a formalized grouping of the developing countries across the globe, and it's currently chaired by the Philippines. The objective is to come up with a program which may or may not include risk transfer to help find solutions to post-disaster liquidity, thereby helping reduce poverty through climate adaptation. Now, preliminary meetings were held in Manila, and further meetings are scheduled for the third and fourth quarters of 2020. Slide 5, please. Now, a word on the various initiatives. Now, Pilla supports and is involved in varying degrees with all of these initiatives. The initiatives themselves are likewise in various stages of development. None of them are actually working yet. We would like to point out that at this juncture, the Pilla's job is to interest its members to participate in a selection of or all of these initiatives. Pilla views it as an opportunity or opportunities to enlarge the premium pie of the industry, given the already high yet increasing capitalization requirement imposed by the Philippine government. We would also like to add that we are cognizant of the role or of our role in helping mitigate the climate and catastrophe risks in our country and countrymen. And we are willing and able to be part of the equation with an insurance solution that should be sustainable. Slide 6, please. Now, what the Philippine insurance sector needs. To arrive at an insurance solution that would meet the target market's needs, be true to the objectives of the project proponent, and to remain a viable and sustainable solution, the industry needs the following. First is an updated and granular data on risks and losses for each of the specific perils that we envision to cover. The second is to have an acceptable model that can help crunch the numbers and correctly price the risks to be covered. Third, a product that is acceptable to all the stakeholders, and that includes the insured, the insurer, reinsurers, regulators, and project proponent. Next is a regulatory sandbox that could incubate such a product and ensure its viability and sustainability in the long term. And finally, a pilot that can amply demonstrate how the product would pan out. So ladies and gentlemen, I guess that sums it up. I'll be very happy to answer your questions.
Thank you, Mr. Rellosa. I'm going to ask a couple of questions now, and then we're actually going to have the next presentation, and then I'd invite everyone to ask questions for both speakers at the end. But Ms. Rellosa, it was very nice to see in your presentation the examples of quite a lot of different schemes and innovations underway currently sort of in the Philippines to address, the climate risk protection gap. And it was also nice to hear that Pilla itself is actually involved in all of these sort of different schemes. So I was just wondering from your perspective of being involved in these different schemes, how they fit together. You should have mentioned sort of, I think, 5 different schemes. So do you feel they're being designed in a complementary way and to sort of support each other and target sort of different people?
Yes, I'm glad you brought that up because we actually see it as some sort of a problem, because it seems that the project proponents are not actually all on the same page, and there are certain overlaps, and it could cause some sort of difficulty for the local industry. So if only the government and or the project proponents could get their act together, prioritize what they want to work on, then it's going to be a lot easier to get the private sector involved in all these initiatives and or programs going forward.
Okay, that's very interesting. And do you feel these overlaps are occurring because of the different stakeholder groups involved in each of the different schemes?
Yes, that would be a source of it, yes.
Okay, then I have just one more question before I go on to the next speaker. You mentioned just from the industry perspective on sort of the conditions that you felt needed to be in place for the Philippine industry to be able to step in and provide the coverage. And one of the
Yes.
things you mentioned was about the regulatory sandbox and how that might help to encourage sort of the industry to come forward. I was just wondering if you could think of any other sort of regulatory measures that you feel might help encourage the industry to provide climate risk insurance.
Well, connected to the first question that you had, I think the regulators could very well be in the driver's seat when it comes to developing these products for the populace. Being in the driver's seat and knowing all the different objectives that the proponents want done, then it's going to be a lot easier, and it's a recipe for success, so to speak.
Sure, maybe just putting you in a little bit on the spot here, but when you say regulators, are you looking to the insurance supervisor or are you looking more to the government? And I think this is also a nice segue probably actually to our next presentation.
Yes, well, first of all, of course, the main regulators for the industry would be the Insurance Commission, and I think they should be in the driver's seat. But having said that, again, it seems that even the different agencies of the government here in the Philippines are not also on the same page. So being the experts in the field, I think it's an insurance regulator who should take the lead.
Sure, that's a nice clear answer. And then no pressure then, Mr. Nayyar. So we're going to move now on to your presentation, and you can tell us from the SEC's perspective what are the different schemes underway in Pakistan to try and close the insurance protection gap on climate risk.
Yeah, thank you, Anna. Can you listen to me?
We can, yes.
Yeah, thank you, Hannah, for giving me this opportunity to present the experience of the developments relating to climate risk insurance in Pakistan. In fact, we have 3 schemes already working, and we are working on the formulation or designing of national agriculture insurance. So I would give the details of these 3, in fact, the 3 schemes and the one on which we are working. So can we have the next slide here? So, I work in the regulator, which is the SECP, Securities and Exchange Commission of Pakistan. SECP is an apex regulator of the capital markets, the non-banking financial institutions, the corporate regulator, and the insurance sector. So it's a regulatory body in Pakistan. So we believe that regulatory framework should provide enabling environment for the microinsurance and climate risk insurance schemes in Pakistan. And in the next slide, I will share you that what we have done or doing with the regulatory framework to provide this enabling environment. So we also believe that the framework should encourage the collaboration and cooperation between various parties such as the insurers, the intermediaries, microfinance banks, government bodies, etc. Luckily, in Pakistan, SECP also regulate the non-banking microfinance institutions. So we in this way, we have some sort of, you can say, ease in handling both the different sides of the microinsurance and the climate risk insurance. Then we believe that framework should recognize and encourage the utilization of technology in the processes and operations. So to promote the technology, I will share in the next slide that we have introduced a regulatory sandbox. So key impediments and bottlenecks which are in the designing and the implementation of climate risk insurance schemes should also be identified and removed. So can we move next slide, please? Yeah. In fact, in the last year, SECP has placed greater emphasis on the inclusive insurance in Pakistan, and this has been recognized as one of the key regulatory objectives. Previously, we had only 3 regulatory objectives, that is consumer protection, generally market development, and the prudential side. But we have in fact included the inclusive insurance as our regulatory objective. So this has really helped us in allocating resources and prioritizing our work. So in our next 3 years strategic plan, we are actually working on bringing the dedicated micro insurers in Pakistan, and I think that these micro insurers will have a direct access to the inclusive insurance market, because currently the micro insurance products are being distributed by the traditional insurers, but the traditional insurers generally focus on more profitable business lines. So they don't generally perceive microinsurance as a profitable avenue. So they more or less they do it as their corporate social responsibility. So, therefore, we at SECP believe that dedicated microinsurers will be helpful in increasing the access of the climate risk insurance in Pakistan. So currently there are microinsurance rules in 2014 in Pakistan, which governs the microinsurance business. And we are considering amendments in the microinsurance rules. As I mentioned that regulatory sandbox has been introduced in Pakistan. We had issued the regulatory sandbox guidelines in last December. And we have also invited applications for the first regulatory cohort. The application period was from February 1 to March 15 this year. And we have received around 28 applications in our regulatory sandbox. The basic objective of the regulatory sandbox was to promote the inclusive insurance and as well as to promote innovation. And this regulatory sandbox is not only for insurance, it is also for microfinance institutions. It is also for the capital market and the non-banking financial institutions, that is the mutual funds and the asset management sector. So we believe that I think this regulatory sandbox will play a very positive role in the development of innovative solutions. And I think these innovative solutions then can be used to really increase the outreach of the climate risk insurance in Pakistan. So can we have the next slide here? In Pakistan, there's a primary insurance law which is called the Insurance Ordinance 2000. That the primary law is under revision in Pakistan. So we have made this is I think a good time for us to lay down the foundation of the microinsurance and the technological developments and the disaster risk insurance in Pakistan. So in Pakistan, we have actually included a separate chapter on microinsurance. Although we are currently working under the microinsurance rules, but the primary law in Pakistan does not deliberate on microinsurance. So when we discussed with our legal team, so we got the answer that the primary law should also provide reference to microinsurance. Then we have also recognized the use of technology such as artificial intelligence and machine learning, blockchain, etc. in the main law. This will help us in actually in bringing these things within our regulatory processes as well. Because when the industry is using the artificial intelligence and machine learning, so I think the regulator will have to change their regulatory processes, and we have recently formed a cross-functional committee within SECP, and we are hiring, in fact, some artificial intelligence experts as well. Then our primary law, which is insurance ordinance, that basically covers only the indemnity insurance schemes. So the parametric insurance schemes are not explicitly covered under the primary law. So we believe that the disaster risk related insurances, a certain layer of risk will have to be covered through parametric and index-based insurance. So we have included the enabling provisions in our main law. And after passing the main law, then we will work on the secondary legislation to govern the parametric insurance and index-based insurance schemes. Can we the next slide? The role of government is obviously, I think that government owns the different you can say different ministries which handle the different sides of the climate risk insurance. So in Pakistan, the government has established a national disaster management authority in which basically handles the disaster risk related insurance and climate risk insurance, and which is, we call it as an NDMA. So that NDMA has created a disaster risk insurance, in fact, disaster risk fund. So one component of that disaster risk fund is regarding disaster insurance. The other components are regarding the reduction of disaster risks. For example, encouraging use of disaster resilient building codes in Pakistan, and also creating a coordination mechanism between the federal disaster risk insurance bodies and the provincial disaster risk institutions. So we believe that the government should take a leading role because the regulator, the insurance regulator has a role, but it is it primarily deals with the private sector insurer and the public sector insurer. So can we move to the current slide? Hello? Yeah, I think this is fine. Yeah. So in Pakistan, the government, I think, is playing its role by creating the National Disaster Management Authority. And also that NDMA has created a synergy group, which I will cover later in the presentation. Can we next? Yeah. So now I will give certain examples which are actually working in Pakistan and which cover also the calamity risk. So first is the crop loan insurance scheme, which we shortly called CLIS. So this was launched in 2008 by this was primarily developed by the banking regulator, which is called the State Bank of Pakistan. So the main objective of this scheme was to encourage the agri lending basically in Pakistan. So it is compulsory for all borrowers availing agricultural production related loans from the banks and the microfinance banks. It mainly covers the 5 main crops: wheat, rice, sugarcane, maize, and cotton. And as you can see, the perils covered are natural calamities and crop-related diseases. Sum insured is based on the per acre borrowing limits prescribed by the banks. And this is an indemnity insurance scheme. So sum insured on the sum insured, there is a cap of maximum 300% times of the premium. This scheme there's a premium subsidy by the government of Pakistan, which is the federal government, to bear the cost of the insurance premium. This scheme works in a way that banks disburse the loans and they also pay premiums of this crop loan insurance scheme to the insurers, and then the insurance companies pay the claims, and then subsequently the banks get subsidy from the government through State Bank of Pakistan. So this scheme has been working for the last almost 12 years. And during the last 12 years, there has been some upsizes of this scheme. Now I will turn on the area yield index insurance scheme of the government of Punjab. Punjab is one of the largest provinces in Pakistan in terms of population. And the government of Punjab, with the help of the World Bank, launched this scheme in 2018 Kharif. Coverage is to protect the income of farmers against unfavorable circumstances. So as the name suggests, this is a parametric insurance. The peril covers are natural calamities and the effects of climate change. The perils also covered the diseases of the crops as well. So this scheme is also mandatory for the landowner of e-credit. Now e-credit is basically a subsidy scheme of the government of Punjab to support the farmers and to increase the access to finance of the farmers. And it is optional for the loanees for the loanees other than the e-credit and loanees landowner of the selected districts. The scheme works as the government of Punjab, through a bidding process, selects insurance companies each year. Overall, the claim ratio in this scheme has been around 26%. The government of Punjab bears the overall cost of this scheme up to the 5 acres holding, and between the 5 acres and 25 acres, the subsidy reduced to 50%. Can you move to the next slide? Yeah. Then we have this livestock insurance schemes for the borrowers. This scheme was also developed by the banking regulator, which is the State Bank of Pakistan. This was launched in 2013. It covers the livestock loans of up to 5 million for the purchase of animals. Sum insured is again the maximum 5 million per borrower. And the animals covered are the local dairy fattening animals comprising buffaloes, cows, and bulls. Perils covered are the death of cattle due to natural disease, floods, heavy rains, and windstorm accidents. So this scheme has also been tested during the some floods in Pakistan. So eligibility are all borrowers availing loan from the banks for the purchase of livestock. But other than the borrowers can also cover this scheme. Participants are all the banks involved in the livestock lending and all insurance companies who are interested to participants. Again, the government is paying the subsidy, which is the federal government, and that subsidy is routed through the Central Bank of Pakistan. So, can you move to next slide? Now, National Crop Insurance Scheme. In Pakistan, the federal government has launched the National Financial Inclusion Strategy with the help of the World Bank in 2015. So National Financial Inclusion Strategy, which we call NFIS, that is a main platform in Pakistan to promote the inclusive insurance as well as inclusion, as well as the general financial inclusion. So under this, there are 7 committees are working. 5 committees are managed by the central bank, and 2 committees are managed by the SECP. 1 committee is on insurance and 1 committee is on pensions. So the insurance committee on the agricultural finance and the technical committee on insurance both recommended the development of the national crop insurance. So national crop insurance scheme has been taken as a actionable item under this NFIS. And then in Pakistan, the Ministry of Commerce, which is constituted a task force, which is headed by the SECP, which is the insurance regulator. This committee was constituted on 22nd January 2020, and we have hold a first SECP is chairing that committee, and there are other bodies as well, such as the State Bank of Pakistan, which is called SECP, the Ministry of Commerce, the local insurance companies, the Reinsurers, and the SPARCO is a meteorological body in Pakistan, then provincial governments and the agricultural departments of each province. So we have held one meeting of this committee, and then we formed 2 subcommittees, and we are meeting regularly. Currently we are considering the design of this national agriculture insurance. So can you move to the next slide now? Apart from this, the World Bank has also created a synergy group in consultation with the National Disaster Management Authority. And the World Bank conducted a disaster risk financing seminar in the UAE in last July. And that synergy group is again is basically creating a coordination mechanism between the Ministry of Finance and the National Disaster Management Authority. This group basically provides the input of various stakeholders, And as a result of this synergy group, the National Disaster Management Authority has established this National Disaster Risk Management Fund. And the Asian Development Bank has also contributed. The government of Australia has also contributed, and the government of Pakistan has also contributed. Overall fund size of this is about $257 million. So that this NDRMF is a public sector non-for-profit company. This is also comes under the regulatory purview of the SECP. So now can you move to next slide? Is it okay? So this is what from my side to share the experience of Pakistan. If you have any questions, so you can ask.
Thank you very much, Mr. Nayyar. I might just start by actually asking you the same question as I asked Mr. Rellosa. You also outlined a number of different schemes, which actually some have now been in effect for a number of years in Pakistan. And I was just wondering from your perspective whether you felt the different schemes were complementary and they sort of fitted well together.
I think the schemes evolved from the different you can say forces of power actually. For example, in Pakistan, the central bank, which is called the State Bank of Pakistan, so that wants to promote agricultural finance. So that's why it launched these two schemes: the crop loan insurance, and then the livestock insurance. But after then both of these schemes were launched pre-NFIS, and when then NFIS was launched in 2014, that is a national level framework. So that's why under this NFIS, then a committee has been constituted which is the National Crop Insurance Scheme. So that scheme will work actually on a national level agricultural insurance. Yeah.
Okay, thank you. I'm going to read out actually one of the questions that's come through on the Q&A, actually also for you, Mr. Nayyar. And this is looking at the crop and the area yield insurance. And the question was, how will you validate the owner of the land? And is this cash assistance only, or does it need an adjuster during the claim?
Yeah, actually, it doesn't need adjuster as it is actually a parametric insurance scheme. So basically, due to the crop cutting experience in the Punjab, the actual yield is calculated by the government's agricultural department, and then actual yield is compared with the benchmark yield. And if the actual yield is lower than the benchmark yield, so the claim payments are being made to that particular unit of area of insurance, which is in Pakistan called the district. And the second question was regarding the verification of the records. So in Pakistan, in Punjab, there is a centralized record keeping agency, which has the record of landowners to a greater extent. So from that, and secondly, generally these borrowers have already taken credit from the government of Punjab. So the government of Punjab have their records.
Okay, no, thank you. Before sort of going to the general Q&A, I'm going to just very briefly invite my colleague Andrea Camargo just to say a little bit about some of the sovereign schemes, because this presentation or this overall sort of session was covering sort of micro, meso and macro solutions. And so far we've focused very much on the micro and a little bit the meso level. So just briefly to bring that perspective into this discussion. Andrea, I hope you're on the call today, and I would ask the colleagues at the Microinsurance Network if you could maybe unmute Andrea's microphone. But yes, I know you've been involved in some of the sovereign schemes, and if you could maybe just very briefly, because we haven't got much time, but just share a little bit of detail on how they work. And I mean, we're looking at the stakeholders and how stakeholders work together, so the different stakeholders that have been sort of involved in their development.
Sure, thank you, Hannah. I might give the example of the Caribbean Catastrophe Risk Insurance Facility, which is a sovereign risk pool that protects right now 19 countries in the Caribbean and 3 countries in Central America. And maybe they have an interesting example on how they are expanding from the role from covering governments to directly covering insurance groups, and also, well, through methodologies through meso and micro at the micro level. For instance, last year, the CRIF made public the interest of insuring utility companies. And also last year, they launched a strategy that is called the Caribbean Oceans and Aquaculture Sustainability Facility, COAST, with the support of the World Bank and the US Department, that is now piloting in Grenada and St. Lucia. What is very interesting about the COAST project, and I think that it helps us to see the synergies between macro and micro, is that even though this policy is still like purchased by the government and obviously aims to protect the government, it also incorporates a livelihood protection component that is very similar to microinsurance. And at the end, this product is covering losses of individuals caused by bad weather and direct damages caused by tropical cyclones to fishing vessels, fishing equipment, and utilities. So it's an interesting way to see the synergies between how a macro solution actually is mutating, we could say, in a way to provide also meso and micro solutions. Also very quickly, just to refer to another sovereign risk pool, which is the African risk capacity. Even though we haven't really seen this kind of transitions, what we have seen is that effectively they are providing a tool to assess risk, understand risk much better. And this tool is helping not only at the macro level, but also at the meso and micro level. Maybe just referring to the supervisory authorities, because I know that you raised awareness about this topic. The African risk capacity is providing training to supervisors as well about these innovative solutions. CRIF and African risk capacity are in parametric solutions ultimately. So yeah, maybe those two examples can help to illustrate a little bit like the synergies between macro, meso, and micro with the African risk capacity and the CRIF.
Thank you, Andrea. I think that was very helpful to bring into the macro perspective there, but also sort of how it is linking and providing solutions at the micro level. We already have a few questions coming in through the chat. So I'm now going to read out some of the questions that have come in. And we have one from Dr. Antonis Malagades from GIZ RFPI in the Philippines. And his question, which I understand is to Pilla, is the insurance industry in the Philippines looking into the effectiveness of disaster risk management measures introduced by the government throughout the country to allow a better understanding and probably contributing into risk mitigation and a reduction of the residual risk? Are there any examples of effective disaster risk management measures at the LGU level that led some PIRA members to offer lower premiums to, and I'm afraid I don't know these acronyms, HHs, or micro enterprises, as they could demonstrate a lower risk level? Mr. Rellosa?
Can you hear me?
We can, yes.
Yes. Can you repeat the question, please?
Sure. It's quite a long question. I'm seeing if I can just sum it up.
Hello?
Hello. Are there any examples of effective disaster risk management measures at LGU level that led some PIRA members to offer lower premiums to micro enterprises?
Oh, okay. If we're talking about microinsurance, there are several actual products in place already. Now, with regard to DRMM examples, I am not aware of any that could have led companies who do dabble in microinsurance to lower their premiums. Perhaps they did from their own statistics, but as far as industry statistics go, I wouldn't have any information yet on that.
Okay,
maybe the companies who lower their premiums did it on the basis of their own statistics.
Okay, no, thank you. I think we have another question, and this is from Jimmy Loro, actually also from GIZ RFPI. This question actually also goes to Mr. Rellosa. Given your experience on climate risk insurance, development at meso and micro levels, what specific sandbox regulatory policies does the insurance industry need in the Philippines to jumpstart or support climate risk insurance for MSMEs?
Well, when we talk about sandbox, usually what regulators look at are always on the distribution side. Now, here in the Philippines, there usually is a problem because if we do come up with a hurdle or come up with a roadblock and it is due to an existing law, then sometimes regulators or people in government can't do anything anymore. They said it's too hard to change the law, to amend the law, etc., etc. So perhaps even legal obstacles can be lifted in a regulatory sandbox regime. So maybe they could ease up even on the way the law is applied, and not just look at distribution and all those.
Okay, no, thank you. And maybe I just ask actually Mr. Nayyar at this point. I mean, you mentioned how Pakistan has introduced a regulatory sandbox. I mean, does that allow certain concessions from the law in Pakistan?
Yeah, the basic objective of the regulatory sandbox was that if there is a certain solution which is not explicitly addressed by the law, or the law disallows that, so that can be worked under the regulatory sandbox in a testing mode under the regulator supervision. So, for example, we have received an application under the regulatory sandbox regarding digital-only insurer with a lower capital. In fact, we are reviewing these applications in Pakistan. So, I mean, currently we have only one licensing regime, but we intend to allow that applicant to operate under an umbrella insurance policy, and through selling policies digitally. And if that works out, so we will issue, then we will actually introduce digital only insurance regime in Pakistan. And we will work along with monitoring the experience. Yeah.
Okay, no, very interesting. Thank you.
Hannah, could I give an example, a practical example here in the Philippines?
Sure, no, please do.
Now, we are working, as I mentioned earlier, on crop insurance, where it's the Philippine crop insurance who's authorized by law to write that kind of policy. Now, as I also mentioned, this is subsidized by the government. And there is, again, another law that states that the government can only subsidize if the subsidy is paid to a government agency. So it leaves no room for the private insurance industry to actually write the policy. So now we're finding ways and means into which we could support the crop insurance via reinsurance or co-insurance or whatever scheme, where the premiums don't go directly to us, but go to the PCIC. And we get the subsidy through some other form. See, so it complicates things. Now, if there is a regulatory sandbox, then all these obstacles can be ironed out.
And you feel the regulatory sandbox will help here because of the opportunity for dialogue, then? Am I understanding that right? Or?
Well, it gives a solution and see how it works. And then in the process, maybe we could then amend the law.
Yeah, that is the thinking in Pakistan, actually, that we thought that basically this regulatory sandbox will be a joint learning experience for the regulator and the innovator. And during the process of that learning and testing, if it works out that things are going in the right direction, then side by side changes can be made in the regulatory framework.
Precisely.
No, thank you. And I think on that note, I'm actually going to bring this webinar to a close. We did start a little late, but we are now also over time, sort of in ending. So I'd like to say a big thank you to my speakers, so Mr. Nayyar and Mr. Rosso, for your very helpful and informative interventions. In the way of just some very short concluding remarks, I think, for me, my takeaway from today's webinar is it does show, I think, the challenge, I would say, in some ways, of coordinating schemes at even a micro and meso level within countries, let alone actually then going on to include the macro level. Although it was nice to hear the example of Coast, where a macro level scheme has been designed sort of looking at the micro level. So there is, some hope, but I was also very pleased to hear of the work going on in Pakistan from the insurance supervisor with its regulatory sandbox, and how hopefully that also provides a bit of a light at the end of the tunnel and helping to ensure that schemes can be developed in the future within countries to provide sort of good climate risk insurance protection, but in a way that would involve all the different stakeholders, I think, in their development. So so a big thank you again for everyone for taking part under, I'm sure in some cases, quite challenging circumstances. And we do have a few other questions left. So what we will do is get back individually to the questions we didn't manage to answer during today's sessions. So yeah, if we can all do a virtual hand clap for the speakers, and thank you for your time this morning.
Thank you.
Thank you.
Bye-bye.
Thank you.